Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Intel.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, so let's get right into this. I have to be honest with you, for the last decade, talking about this company felt a bit like, I don't know, talking about a typewriter manufacturer in the age of the iPad.
Yeah.
It was the stock your dad bought in the 90s that just sat there. It collected dust. It lost market share. But looking at the research you've pulled for today, the charts are telling a completely different story. Something massive has changed.
It's a massive shift. I mean, we are not looking at that dusty legacy chip maker anymore. What we are witnessing, and the data totally supports this, is the return of the national champion. This is a company that has fundamentally changed its DNA to become the backbone of what we're calling sovereign silicon in the United States, and the market is, finally waking up to it.
Sovereign silicon. I like that term. It sounds expensive, but also necessary.
It is expensive to build, but it's proving to be incredibly profitable for investors who timed this right. Depending on exactly which metric you look at, the stock is up anywhere from, 84% to 130% over the trailing 12 months leading into this January of 2026.
Wow.
So if you were one of the contrarians who bought when everyone was writing their obituary back in 2024, you are laughing all the way to the bank right now.
That is a huge move for a company of this size.
Yeah.
But look, we've seen head fakes from them before. They promise a turnaround, the stock pops, and then they miss a deadline or delay a product. Why should we believe this isn't just another false dawn? What makes this time different?
That is the critical question. The core thesis for anyone listening is that you have to stop thinking of this company as just the brand that sells the processor inside your laptop.
Okay.
That is the old thesis. The new thesis is built on the IDM 2.0 model.
Break that down for us. IDM 2.0.
Integrated device manufacturer. So historically, they designed chips and built them for themselves. IDM 2.0 means they are still designing chips, yes, but they are pivoting to become the factory, the foundry for the entire AI revolution. They want to manufacture chips for their competitors.
So instead of just being a tenant in the building, they want to be the landlord collecting rent from everyone else.
That is a great analogy. And we just got the first major validation that this isn't just a PowerPoint presentation anymore. The Q4 2025 earnings dropped late January. The street was expecting, let's just say they were nervous.
Modest expectations.
Very modest. But the company delivered revenue of $13.7 billion.
Which beat the estimates.
It beat them handily. But the real story wasn't the top line. It was the bottom line. Earnings per share came in at 15 cents versus an expected 8 cents.
Oh, wow. That's nearly double.
Nearly double the expectation.
That's significant. It proves they aren't just burning cash to build these factories. They're actually operating profitably again.
Exactly. They have stabilized the ship. They are profitable again.
Okay, so the ship is stable. Let's look at the engine room. Where is this money actually coming from? Because we hear AI thrown around by every CEO with a microphone. Is AI actually showing up on the balance sheet here, or is it just marketing fluff?
It is finally showing up. If you look at the full year 2025, revenue stabilized right around that $53 to $54 billion mark. That's the floor.
Right.
But if you pop the hood and look at Q4 specifically, the data center and AI segment, which is really where the future growth lives, grew 9% year over year to $4.7 billion.
9% isn't exactly rocket ship growth compared to some other AI names, but for this company, that's a reversal. For a long time, that segment was shrinking, right? They were bleeding share.
They were hemorrhaging share. This shows they have stemmed the bleeding. They are defending their turf. But, and we have to be really clear about this, the cash cow that pays the bills is still the client computing group.
The PC chips.
The PC chips, yeah, the division making chips for PCs and laptops. It's still about 62% of their revenue.
Which sounds risky to me. Isn't the PC market dead? Or at least, saturated?
It was saturated. But we are entering a new super cycle. The AI PC replacement cycle.
I keep saying that term, AI PC. Is that just a laptop with a dedicated button for a chatbot? Or is there real hardware differentiation there?
It's real hardware. It means the laptop has a neural processing unit, an NTU, built right onto the chip. It allows you to run AI models locally on your device without sending data to the cloud.
Oh, interesting.
Companies want this for privacy, gamers want it for performance, creatives want it for speed. That demand is driving volume.
Okay, so volume is up. But volume is vanity, profit is sanity. You can sell 1 billion chips, but if your cost structure is bloated, you make $0. And historically, this organization was notoriously bloated.
Oh, it was incredibly heavy. And this is where the turnaround story gets credit not just for vision, but for execution. We have to talk about margins. Gross margins have recovered to roughly 40 to 45%.
That is a massive jump from the dark days of 2024. I remember when they dipped into the mid-30s and Wall Street panicked. Who fixed this? Is this all the CEO's doing?
The CEO set the vision, but for the financial discipline, you have to give a massive amount of credit to Lip Bhutan and the cost discipline he instilled. They reduced annual operating expenses to $17 billion in 2025.
$17 billion. That still sounds like a lot, but give me some context.
They are targeting $16 billion for 2026. They are stripping out billions of dollars of inefficiency. It's a lean, mean operating machine compared to the bureaucracy of the past.
So they kept the fat.
They cut the fat, but importantly, they kept the muscle, the R&D budget.
Right, because in tech, you can't save your way to growth. You have to innovate. But speaking of money, we used the term national champion earlier. That usually implies the government is involved.
Heavily involved. This is arguably the biggest safety net in the entire stock market right now. They secured $8.9 billion in HTTPS Act direct grants and equity.
Wait, pause on the equity part. The U.S. government actually owns a piece of the company now.
Through the funding structure of the CHIPS Act, yes. Effectively, the U.S. government holds a stake roughly equivalent to 10%.
Wow.
They have signaled to the entire world that this company is too strategic to fail.
That changes the risk profile completely. If I'm an investor, I'm thinking, the White House needs this stock to work. They can't let these massive new factories in Arizona and Ohio sit empty.
Exactly. It de-risks the downside. And then you add the commercial validation. SoftBank invested $2 billion recently. So you have the U.S. government and one of the world's biggest tech investors both putting billions on the table.
It's a powerful vote of confidence.
And it leaves them with a cash position of over $30 billion. That is crucial because building semiconductor fabs is the most expensive construction project on Earth. They have the cash to finish the job.
Okay, so they have the cash, they have the government backing, and they have the margins coming back. But let's talk about the actual product, because for years, the knock on them was that the competition, specifically TSMC, was just better.
Right.
Their chips were smaller, faster, cooler. Is that narrative finally dead?
It is on its deathbed, certainly. The entire future of the company hinges on a specific technology node called 18A.
18A. Help us understand the scale here. We used to talk about 14 nanometers. 10 nanometers, 7. What is 18A?
So 18A stands for 1.8 angstroms. It's the metric beyond nanometers, but the number isn't as important as the architecture. The crown jewel technology here is something called PowerVia.
PowerVia. Sounds like a sports drink. What does it actually do?
It does give the chip energy, actually. Think of a standard computer chip like a busy city. Traditionally, the power lines and the data traffic, the cars all share the same roads on the top level. It's crowded.
A traffic jam.
It's a traffic jam. There is interference. You lose efficiency. PowerVia takes all the power lines and buries them underground on the backside of the silicon wafer.
Okay, that makes sense.
So the top is just for data and the bottom is just for power.
Clean. Efficient.
Extremely efficient. It clears up the traffic. Because of this, they are potentially ahead of TSMC's 2-nanometer capabilities in terms of performance per watt.
That is a huge claim. If they're beating TSMC on performance per watt, that changes the whole ballgame.
Yeah.
Apple, NVIDIA, Qualcomm, they all care about power efficiency more than anything else right now.
Exactly. And we are seeing it in the products launching right now.
Yep.
The Panther Lake processors are built on this 18A node. They are hitting the market as we speak.
And this ties back to that AI PC boom you mentioned.
It does. Projections show AI PC shipments rising 52% in 2026. This company isn't just in a few of them. They are powering over 200 different designs.
200.
They are saturating the market before competitors can even blink.
So they have the product. But the blue sky potential, the reason you'd hold this for 5 years, not 5 months, is the foundry strategy. We touched on it, but walk me through the economics.
This is their Amazon Web Services moment. Amazon turned their internal server costs into a profit center called AWS. This company is trying to turn their factories into a profit center called the foundry.
Who are they selling to?
Everyone. They are targeting a $100 billion addressable market for custom chips. what we call ASICs, mostly for AI and networking. And getting back to the national champion theme, they just secured the Secure Enclave contract from the U.S. Defense Department.
How much is that worth?
$3 billion.
And defense contracts are sticky, right?
Right.
Once you design a chip for a fighter jet or a secure server, the Pentagon doesn't just swap you out next year for a cheaper competitor.
Never. It's incredibly high-margin, reliable revenue that competitors basically cannot touch because they don't have the domestic factories.
Yeah.
TSMC can't bid on that effectively.
Okay, let's pivot to the charts for a second. The technicals. We mentioned the stock is up big. Does that mean we missed the boat? Is the easy money already made?
You know, analysts are calling this a resurgence pattern. The stock has broken out of its 2025 lows decisively. Following CES 2026 and the meetings between CEO Liputan and the U.S. president, we saw a surge of over 10%.
And that tells you something.
It tells me big institutions are buying. Retail investors don't move a stock of this market cap 10% in a day.
I saw mention of a golden cross in the notes. For the listeners who aren't technical analysts, that's when the short-term moving average crosses above the long-term average, right?
Correct. Usually the 50-day crossing above the 200-day, it signals long-term momentum. The stock is acting like a market cap mover again, rallying alongside the big boys like Microsoft and Lam Research.
But is it expensive? Usually when a stock doubles, the PE ratio gets scary.
That's the fascinating part. Despite this rally, Melius Research is calling it so cheap compared to TSMC.
Why the discount?
Because the market is still skeptical, they are pricing it as a PC maker that is doing okay. They aren't pricing it as a global foundry leader yet. That gap between how it's priced and what it could be is the opportunity for the investor.
So the street is starting to wake up. What are the analysts actually doing? Are we seeing upgrades?
It is shifting rapidly from wait and see to FOMO. You have Melius Research with a buy rating and a $50 target. KeyBank just raised their target to 65 with an overweight rating. Seaport upgraded to buy.
And nothing drives a stock price like a good rumor. The mill is spinning right now. What is the chatter?
The biggest whale in the ocean is NVIDIA. There is persistent, loud speculation that NVIDIA may use this foundry for manufacturing.
Now, play devil's advocate. Why would NVIDIA do that? They love TSMC. They've built everything together.
Two reasons. One, politics. To appease U.S. regulators who are desperate for domestic supply chains. Two, risk. If something happens in the Taiwan Strait, a blockade, an earthquake, anything NVIDIA's supply goes to zero. They need a backup plan.
And this is the only game in town, really.
This is the only high-end backup plan.
That makes total sense. Even getting 5% of NVIDIA's volume would be billions in revenue.
And then there is the Apple rumor. Speculation about Apple using the 18A node for their M-series chips around 2027. Again, purely speculative, but remember, Apple is ruthless. If the 18A node proves to be better than TSMC's process, Apple will move. They go where the performance is.
Okay, we've painted a very rosy picture here. National champion, government cash, tech leadership, Apple rumors. But we have to be realistic. This is still a turnaround story, and turnarounds are messy. What is the bear case? What goes wrong?
Right. It's not all sunshine and rainbows. There is a specific air pocket coming up in Q1 2026.
An air pocket, like turbulence.
Exactly. Despite the great Q4, the guidance for the first quarter of 2026 was actually pretty weak revenue between 11.7 and 12.7 billion. When that news hit, it caused a temporary sell-off.
Why the drop? Is demand drying up? Because that would kill the thesis.
No, and that is the key distinction. It is not a demand problem, it is a supply problem. They literally cannot make the chips fast enough. They are facing shortages in packaging, specifically a tech called CoWoS and memory components. They have completely sold out of their server CPUs.
So they're leaving money on the table because they physically can't ship the product.
Exactly. It is frustrating for investors in the short term, but too much demand is a better problem to have than no demand.
True, but what about execution risk? We're betting the house on this 18A node working perfectly.
That is the biggest risk, 100%. If the yields are low, meaning if too many chips come off the silicon wafer defective, the whole profitability thesis breaks. And remember, the foundry business isn't expected to be fully profitable until 2027, so you are buying a promise right now.
And the competition isn't sleeping. AMD is dropping great chips. NVIDIA is NVIDIA.
They have to claw back market share in the data center. It is a dogfight. They aren't walking onto an empty field.
So, knowing all that, the massive upside, the government backing, but also the supply constraints and the execution risk, where do we land? How should the listener approach this?
Well, if we look at the next 3 months, we have a clear catalyst calendar. April 2026 is Q1 earnings. Investors want to see that supply trough bottom out. They want to hear, okay, we fixed the packaging, we are shipping everything we can make.
And we're waiting for the Panther Lake numbers.
Right. But the big one, the game changer, would be the official naming of a major external foundry customer. If they announce a whale, like NVIDIA or Apple officially, the stock re-rates overnight.
So give me the score.
I am giving this a bullish score of 8 out of 10.
8 out of 10. That is high confidence.
The thesis is strong. It is a multi-year hold. This stock is essentially the U.S. geopolitical hedge for AI. If you believe AI is real and you believe the U.S. government wants to control the hardware, you simply have to own it.
That's a compelling argument. My summary is pretty simple. That short-term pain in Q1, that air pocket, that looks like an opportunity to me. If the stock dips because they can't ship fast enough, that feels like a buying window before the 18A revenue really kicks in later in 2026.
I agree. You are buying the infrastructure of the future at a discount because of a temporary bottleneck.
Well, there you have it. That is the lowdown on the state of sovereign silicon, from forgotten giant to powerhouse.
It is going to be a fascinating year to watch.
Absolutely. If you found this breakdown helpful, don't forget to subscribe and leave a comment below. Let us know, do you think they land NVIDIA as a customer? Or is that just wishful thinking? We want to hear your take.
Thanks for listening.
Catch you next time.